Welcome back to today's Explainer. We constantly hear the financial press talking about central banks, quote-unquote, printing money to save the economy or wrangle inflation. But how does that actually work under the hood? Well, today, we're going to demystify the true architecture of money. We're going to strip it right down to its foundational base to show you exactly how wealth is created, multiplied, and circulated in a modern economy. Let's get right into it.
Here is our roadmap for today. We'll kick things off by defining the money supply, then we'll look at high-powered money, dive into the mechanics of the money multiplier effect, and finally, wrap up with a real-world case study on bank runs.
All right, part one, defining the money supply.
So, in everyday conversation, if someone has a lot of money, we usually just mean they're wealthy, right? Maybe they own a lot of real estate, or cars, or an entire portfolio of stocks. But to an economist, money is strictly defined by liquidity. It's the stock of assets you can readily use to make transactions, right here, right now. I mean, you can't exactly buy your weekly groceries with a fraction of your house. You need a universally accepted medium of exchange.
Let's look at how we actually measure this stock. We categorize it on a spectrum from the most liquid to the least. At the base, C is just your physical currency, the paper and coins in your wallet. Stepping up to M1, that adds your standard checking accounts. Then M2 broadens it out further by throwing savings deposits into the mix. And while a lot of baseline data focuses heavily on M1 and M2, it's really interesting to note that central banking systems around the world often cast a much wider net. Take India's Reserve Bank, for example. They use extended measures like M3 and M4 to capture things like long-term time deposits and post office savings. This gives us a much wider, honestly a more comprehensive picture of total liquidity across an entire national economy.
Now, looking at this data, here is the absolutely crucial takeaway. Physical dollars actually represent just a tiny fraction of the total money stock. The vast majority of what you and I consider money isn't paper and ink at all. It's literally just digital entries in bank ledgers. And this means the banking system isn't just a giant vault for storing your cash. It is an active, dynamic engine that literally creates the money supply.
Which brings us to part two, high-powered money. There is a critical difference between the broader money supply and the underlying monetary base. As you can see, both of these include the physical currency circulating in the hands of the public. But while the overall money supply includes all those digital demand deposits created by banks, the monetary base is strictly limited to the actual physical reserves held inside the bank's vaults.
This monetary base, so currency plus bank reserves, is entirely controlled by the central bank. And economists have a great name for it. They call it high-powered money. Why? Well, because every single dollar in this base acts like a highly potent seed. When you plant that seed in the fractional reserve banking system, it blossoms into a significantly larger money supply for the broader economy.
Okay, part three, the money multiplier effect. So how exactly does that high-powered seed actually grow?
We can actually map out this growth using a little bit of algebra here, but honestly, it all boils down to two human behavioral choices. First, you have the currency deposit ratio. Basically, how much physical cash do you prefer to keep in your actual wallet versus leaving it in the bank? And second, the reserve deposit ratio. What fraction of your deposits does the bank actually hold on to in their vault versus lending out to the next guy? By combining these human and institutional choices, we derive the money multiplier, which is the exact mathematical factor by which that base money expands.
And that brings us to this incredibly elegant equation. Total money supply equals the multiplier times the monetary base. This is huge because it proves that governments don't just print the money supply. They only plant the seed. The actual money supply that you and I use on a daily basis is dynamically multiplied by our own behavior and the lending practices of our banks. Let's make this concrete. Say banks hold 10% in reserve, and the public holds a certain ratio of cash. The math might output a multiplier of exactly 2.0. So, to put that into perspective, for every single new dollar the central bank injects into the system, exactly $2 of circulating money are generated out there in the real economy.
All right, let's move to part four, case study on bank runs.
We need to test this elegant theory against real-world data, specifically during a catastrophic failure, the Great Depression. Look at this fascinating paradox from the early 1930s. Over just 4 years, the total money supply completely collapsed, which obviously devastated the global economy. Yet, if you look closely, during that exact same period, the monetary base actually expanded. The central bank was pumping more high-powered money into the system. So, why on earth was the overall money supply plummeting?
Well, the culprit was an absolute crash in the money multiplier. It plummeted from a healthy 3.7 down to just 2.3. The central bank was effectively pushing on a string. I mean, they increased the base, sure, but the multiplier engine itself was completely broken.
So, why did the engine break? In a word, panic. The public lost confidence in the banks, so they started frantically withdrawing and hoarding physical cash. Simultaneously, terrified bankers completely stopped lending and started hoarding reserves just to survive the bank runs. Remember those two behavioral variables we talked about earlier? They radically shifted overnight, completely suffocating the multiplier.
The entire system essentially ran in reverse. As the quote here highlights, banks responded to lower reserves by reducing their outstanding balance of loans. The banking system physically could not intermediate credit. This didn't just slow the economy down, it actively destroyed the broader money supply, regardless of how much base money the central bank tried to desperately inject.
We've seen today that while the central bank controls the base, the final money supply rests heavily on human psychology. So I'm going to leave you with this final thought. If the money multiplier relies entirely on the unpredictable, volatile emotions of fearful depositors and cautious bankers, can a central bank ever truly control the economy during a panic? Something to think about. Thank you so much for joining me for this explainer, and I'll catch you in the next one.